In one of my other episodes, the basing points episode, we talked about how to set emergency stop losses. Now, that entire program was for emergencies only, like black swan events, like for instance this day where a stock could drop over 10%. All right, so we usually don't want those emergency stops to be the ones that stop us out because normally, like I showed in the basing points method, we would set the stop 7% below a certain level. So we're taking a lot of risk by setting the stop that far off from our point. So we could lose 7% in a day. But like I said, it's like insurance. It's like insurance. So today we're going to talk about how to set standard stops when trading. So right now I have First Energy Corporation. I think that actually this stock is the worst performer of 2010 in the S&P 500, but I own about half a share of it, and they send me a 37-cent check 4 times a year for it. So I knew what it was. All right, so let's say first we gotta find our entry point. I'll move out just if you notice for the past 10 years, First Energy has really been in an uptrend. It's been in a long uptrend. So, but you can't always get in at the very beginning of an uptrend. So sometimes you have to get in the middle of it. So I'll move back to the 5-year chart. Say that we see this day right here, and we're in the middle of 2000 and in the middle of 2006, about here. Say we see. Actually, I'll zoom in. Hold on. Say we see this day right here, and we wait, what's going on? Try to see if we have a continued uptrend going on. We don't do anything, and we see that we basically have a resistance line right here. Alright, we notice that we have a resistance line. I'll extend that at around 42, 42.50, 43. Doesn't really matter too much because I'm not looking for the exact price right now. I'm just using it as an example. So we have our high here, goes down. We're saying I am not buying that. I am not buying that. Not buying, and then hits the resistance once, hits the resistance again, and then breaks through. This is what's called a double bottom. I was talking about what a rectangle is in the price channel episode, and this is a double bottom because one bottom, two bottom, that one doesn't count. So one bounce, two bounce, and then breakthrough continues the trend. So on that note, we would want to enter the trade about right there. Alright, so we're entered a trade now. I'll zoom back out. We want to set our stop point. I'm going to say with this trade, not even knowing what is going to happen next. So I'll zoom in this far. So we don't even know that it went up after this. At this point, I want to set my stop. I want to set my, if I'm very conservative, very edgy, I will say I'm going to get out when the price closes below this line. Okay? So I'll put a small label there. Exit when price closes below 42.50. Conservative. Alright, hopefully you can see that. Exit when price closes below 42.50. That is one standard stop that we could do. Now, I usually don't like doing that because you get too many false signals, and sure enough, a lot of the times it will go. you'll see after this, I'll zoom out a bit. After it'll break through this resistance line, it'll come back and bounce right to it. So sometimes it'll come right down here. Just imagine the blue line's the stock price, and then after that it might go a little below it, and then it'll continue going up. That's just called a pullback rally or a throwback, depending on what direction you're going. Alright, so I'm going back here. If you're aggressive and you're willing to take some more risk, then your stop is going to be anytime it closes below here. Aggressive, exit when price closes below 42.50. Alright, so when I actually get in the trade, I don't like having an actual order because there's too many false signals that come up, and I don't want to get stopped out of the trade when it might just go right back up. So when it closes, say when it closes below 42.50 and I'm conservative, I won't set a stop order in my at the market price. I'll set it about, for a stock like this, I'll set it 12 cents below the close of the last day. So that will help me. It'll give me open exposure to if the stock goes down more, and I still won't be risking too much. So if it closes at, say, 42.49, next day I'm going to have my order in at 42.37. And same thing goes with the aggressive one. It's just, like I said, filter out false signals. Alright, so if I think that I basically said it all. You could also do it with what's going on right now, since now it looks like it's in a continued uptrend. But as we were talking about today, setting your standard stops, and always stick to your guns, get rid of the emotions, and if you got any questions, email me or listen to the radio show, ask questions. I'll put the link at the bottom of the page. Thanks, and have a good day.